All right, today we're putting two funds in the ring for a head-to-head showdown. In one corner, you've got CEFs, in the other, CEFD. Now, both of these are basically funds made up of other funds, but here's the kicker. They have completely different game plans for making you money. So, which strategy actually wins? Let's dive in and find out. And right out of the gate, you can see the fundamental conflict here. With CEFs, you're getting an active manager. Think of a team of pros making moves every single day, trying to sniff out the best deals. But with CEG, you have a leveraged indexer. It's a fund that just follows a formula, but it juices the recipe with a pretty powerful and risky ingredient. This is the classic battle: human expertise versus a supercharged algorithm. To really wrap our heads around this, let's use an analogy. Let's think of CFS as a gourmet chef and CFD as a high-tech baker. They both want to bake a delicious cake, right? But their methods for getting there, they couldn't be more different. So what does it actually mean to be a chef in the world of investing? Well, it's all about active management. Instead of just following a recipe card, the managers at CFS are in the kitchen every single day. They're tasting, they're tweaking, they're using their experience to create a totally unique portfolio that they believe will beat the pants off the regular market. And this is where we get a peek at the chef's secret recipe book. The team running CEFs isn't just throwing things in a pot. Nope. They are actively hunting for funds that are not only spitting out high income, but are also trading for less than they're actually worth. Plus, they throw in some defensive ingredients, like protection against rising interest rates. And they're constantly trading. It's about as hands-on as it gets. Okay, so let's walk over to the other side of the kitchen and see what our baker is up to. CFUFD, on the other hand, uses a passive strategy. This means there's no team of chefs making gut calls. It's more like a baker with an incredibly precise recipe. In this case, it's an index of closed-end funds. It follows that recipe to the letter, buying exactly what the index says to buy, no ifs, ands, or buts. But this baker has a wild secret ingredient. CEFD adds leverage. It actually borrows money so it can invest 1.5 times the amount it has. Now, why would they do that? Well, the goal is to amplify the index returns by 50%. So if the index goes up 10%, CEFD is shooting for a 15% gain. But, and you got to hear this part, that leverage is a two-way street. Losses get amplified by the exact same amount. It is the absolute definition of a high-risk, high-reward play. So, we've got our chef using skill and intuition, and our baker using a precise recipe with a turbocharger strapped to it. Let's really get under the hood now and compare their core ingredients side by side. This tale of the tape really lays it all out, doesn't it? CEFS. It's active, holding 83 different funds that were handpicked by its managers, and importantly, it uses zero leverage. CEFD. It's passive, just tracking an index, but it's rocking that powerful 1.5x leverage. I mean, these are two totally different worlds, even though they're both aiming for the same thing: growth. And here's that look inside the chef's kitchen. This chart shows us what's in the CEPS portfolio. And you can see the managers have spread their bets across a bunch of different asset classes. Little over half is in stocks, almost a quarter is in bonds, and then the rest is scattered across alternatives and mixed funds. This diversification, it's a huge part of their active approach to managing risk. Of course, a gourmet chef is going to cost you more than a recipe book, right? And you can really see that here. The total annual expenses for CEFS are a pretty hefty 4.29%. That's what you pay for that active management team. CEFD, because it's just a passive fund, is way cheaper, at just under 1%. So that brings up the million-dollar question. Is that chef's expertise really worth that much more? Okay, we've seen the strategies, we've looked at the ingredients, we've talked about the costs. Now, it's time for the main event. We are going to put these two funds head-to-head in a real-world performance test to see what really happens. So let's set the stage. I want you to imagine it's June of 2020. That's the day CEFD launched. You've got 20 grand, and you decide to split it right down the middle. $10,000 goes to our active chef, CEFS, and the other $10,000 goes to our leveraged baker, CEFD. Now let's fast forward to February 2026. Who do you think came out on top? And here is the answer. Wow. This chart tells an absolutely dramatic story. Both funds start at 10 grand. That blue line, our leveraged baker CEFD, is just all over the place. Huge swings up, huge swings down. But the black line, our active chef CFS, charts a much steadier, more consistent upward climb, especially in those later years. The difference in their journeys is just staggering.
Let's put some hard numbers on that picture. The final scorecard is in, and it is a decisive win for the chef. That initial $10,000 in the actively managed CEFS more than doubled, growing to over $22,600. The same 10 grand in the leveraged CEFD, it grew to just over 16,000. We're talking a total return of over 126% for the active fund versus about 63% for the leveraged one. Not even close.
So the results are in, but the story is not over. The big question is why? Why was the outcome so incredibly one-sided? And more importantly, what are the key lessons we can all take away from this financial showdown? Let's break it all down.
So what do we learn here? Well, first, strategy matters. A lot. In this particular face-off, the hands-on approach of the chef delivered more than double the return. Second, and this is a big one, leverage is a seriously double-edged sword. It feels great when things are going up, but it absolutely crushes you on the way down. I mean, at its worst point, CEFD was down almost 47%. Third, costs aren't the whole story. The fund with a fee that was 4 times higher actually delivered a much better result after all those fees were paid. And finally, you just have to look beyond the ticker symbol and really understand what's going on inside the fund you're buying.
And that brings us to the final thought I want to leave you with. Look, this one example doesn't prove that active always beats passive or that high fees are always a good thing, but it absolutely forces us to ask a really critical question about our own portfolios. Are we paying more attention to a fund's price tag than to its actual strategy? What do you think is more important? Thanks for tuning in.